Well, welcome to my channel, Life in Tampa and surrounding areas. Would you like to know which loan is the best for you? Well, today I brought a lender that will give us a better understanding of why these different loans, like FHA, conventional, VA, and USDA. But first, if this is your first time to my channel, do me a favor, hit that subscribe button and that little bell so you'll be notified every time I release a new video. So let's go. And for those of you that don't know me, my name is Rivera, a local realtor here in the Tampa area. I am trilingual and I've been living in Tampa for almost 35 years. So my goal in this channel is to share everything you need to know about Tampa Bay area and any information about real estate. So let's see what the lender has to say.
So, as I mentioned, today I will talk about different types of loan. And today I brought again a mortgage lender that would explain all of these things for you. And here is Eric Bowers. Go ahead, Eric.
Hey everybody. Nice to be here again.
So we are going to talk about different type of loans. Let's go ahead and name some of the loans and the loans that you're going to talk about, and just go ahead and get started.
Yeah, when people think about kind of the big four loan types, there are FHA, conventional, VA, and USDA. And those are sort of the big loan types. Lenders like myself, we also have non-qualified mortgages, which gets into a whole exotic world. But today we're going to talk about the big four. So let's start with FHA. I'll give you an example of why someone would use an FHA loan over any other loan type. Let's say I have a 590 middle FICO score. Okay, it's not the best I've ever seen as a lender, right? But technically speaking, it is still lendable under the FHA program. If you have a minimum credit score of 580, in theory, because there are a bunch of other characteristics that go along with it, but in theory, you could get approved for an FHA loan. So every single person's scenario is different. Repayment history is a big factor. Down payment, reserves, which I can explain, those are all big factors. But an FHA loan would allow that and allow for at least the opportunity for approval. And when I submit an FHA loan, I do that because the person's got a credit score that maybe is not like the best when they're putting a minimum of 3.5% down in an FHA program. Let's say the person comes to me and they say, look, I got a gift from my mother and I'm going to pull from my retirement savings. And all in all, I can just piece together $20,000. I'm like, okay, let's look at an FHA loan. The seller, if they're so inclined, can give you a little bit of money back. They can actually give you up to 6% of the purchase price back to help with your closing costs, and that'll ease some of the burden. Depends on what market you're in. That might not apply at all today in your market in May as we record this, May of 23. So it's dependent upon the scenario, the seller, what they are looking for. I mean, they might not be able to give a seller credit because of their financial situation. But FHA is a pretty lenient loan, and it allows for looking at student debt in a different way than maybe a Fannie Mae loan might. And it allows for higher debt ratios overall than some of the other loan types. So FHA is a really, really good loan. It's not only for first-time buyers, but it's a really good loan for first-time buyers and those with credit scores that are less than stellar.
So on FHA loan, that would be for somebody that's going to do a primary home, right?
Yes. Yeah, only
Right.
a primary home, no vacations, no investment.
Okay, good. That's what I wanted to touch up on because people ask those questions too.
Yeah.
Their credit score can be as low as 579, you said?
580 right now, and you can still put down as little as 3.5%. But again, every single loan is different. Everyone's credit history has different characteristics, and FHA does take that into consideration. So you could have a 615 credit score and still be declined.
Right. So because let's say, the fact that it's 580, how will that affect their interest rate? Will that affect their interest rate?
Yeah, it'll affect their interest rate, and the cash to close will be higher. Because if you think about it from a lender's perspective, if you, the customer, have a lower interest rate, maybe you haven't made some of the best financial decisions in the past, and that's okay. But the lender needs to take on either a higher interest rate to get compensated for the risk that they're taking, or money up front due at closing in what's known as points. Points are like actual money out of the buyer's pocket due to the lender at closing. So you could have someone with a 710 credit score and someone with a 610 credit score, both pursuing an FHA loan, identical place, identical zip code, street address. And the person with a 710 credit score will more than likely pay less to do the loan, to get into the loan, than the person with a lower credit score, because they've shown some repayment history that might be a little bit more stable in the past.
So that's what's important. That's the reason why the credit score is important. And people sometimes don't understand that, and they want to ask me those questions, and I'm like, nope, call Eric.
Yeah,
he'll explain that stuff. So that's important for them to know why they have to work on their credit. Then the next one would be the conventional. Can we tell us about conventional?
Yeah, that's the loan type that most lenders sort of look to first. I guess overall, I'm generically speaking now. The reason for that is a couple reasons. As a first-time buyer with a conventional loan, you might not know that, but you could actually put down as little as just 3%. You don't have to put down 20% or some big crazy number. If you haven't owned a home, a property in your name in the past 3 years, you're actually a first-time buyer. You might come in and look at a $400,000 home and put $12,000 down because it's 3% of $400,000, and cover your closing costs. And now you're into a home for $24,000, whatever it takes to get you in that home. And so conventional loans are really good because they are the property itself. You can get away with a little bit more in the appraisal, which all lenders hire a third-party appraisal to review the property. And things like broken floorboard or paint chipping, where that actually will stop an appraiser in their tracks on an FHA loan and require that those be fixed, they might be overlooked on a conventional loan if it's not really a factor. So it's a little bit more flexible. Typically, you're going to want a conventional loan when your credit score is high enough to where the pricing makes the most difference. Here's what I mean. As a lender, someone comes to me with a 675 credit score. I could literally go either way, FHA or conventional. I'm assuming they're not a veteran nor buying in a USDA area, which I'll get to in a second. I could look at both pricing for them and I'd say to the realtor, do you think we need a conventional loan? Because I can get them a higher price point with FHA because of the allowance that FHA makes for other debts in the person's life, because everything's considered: your car payment, your credit cards, student loans, co-signed loans for other people. All of that is considered. It's not just the house. It's not just the house payment. And so if you're comparing apples to apples, a conventional loan may limit the person over what an FHA can do, but the conventional loan will also allow for the mortgage insurance to either be gone immediately up front. That's a monthly charge that the customer pays if they're putting less than 20% down. You can either have a lender finance that mortgage insurance for you and sort of like tuck it away so you don't see it and you don't like really feel the payment monthly. Or if you're putting 20% down, you have no mortgage insurance. Where with FHA, you have mortgage insurance whether you want it or not. You could put 80% down on an FHA loan and still have mortgage insurance, whereas a conventional loan, you don't. Also, the appraisal. If I'm a seller and I am offering my property for $300,000 and I say, I'll offer it to you, Luciana, but I'm not going to take anything less than $300. I'm just telling you off the bat, I'm not taking anything less than that. And you say, okay, I'll pay you $300. And your lender hires an appraiser. And the appraiser comes out and says, hey, good news, gang, the property's worth $280,000. I said I wasn't going to take anything less than $300. And you, as a customer, are saying, wow, I don't want to come up with another $20,000 out of pocket because it's only worth $280. My lender's only going to lend against $280 minus my down payment. So I'm going to have to come up with another $20,000 to make up that $300,000 that this greedy seller said they were going to take. Well, if that's the case and you walk away, you as the buyer walk away from the deal and say, I'm sorry, I can't buy it. It's too much. I as a seller can say, okay, fine, I'll sell to somebody else. If the next person that steps up to buy my property has an FHA loan, that old lower appraisal that you just did as a potential FHA buyer is now stuck to my property. It's stuck to my property for it's up to 6 months. It really inhibits you sometimes as a seller if you think you're overpricing your property and haven't done your due diligence to know what the market really bears, and you're taking a chance on selling your property for higher. That's why some sellers will say cash or conventional only. It's not only because of the physical condition of the house. It might be taking a chance to allow for a higher sales price than what the property is worth. So the same scenario with a conventional loan, if you walk away, I'll say, fine, bye-bye. Someone else is going to step up and try to buy this place, and your appraisal goes with you. It's not stuck to my house on a conventional loan. So that's the difference there. So conventional, it's more attractive for a seller to take because there's a little bit less risk for a seller, both in the physical condition and the overall sales price scenario, like I just described.
On the conventional loan, you said that it could go either 3% or, I know that it can, but I never understood when it could be 3%. I always thought it would be 5%. Can you explain that, when it would be a scenario of 3%?
Yeah, if you're a first-time buyer, so literally if you've never bought a property, doesn't matter if you make $820 million a year, when you want to buy a home, you can put 3% down. There's no income limit on it as a first-time buyer. So you could put 3% down if you haven't owned a home within the past 36 months. So
with conventional, you're saying?
For conventional loan. FHA, let's say you've bought and sold a few homes. As long as you don't have more than one FHA loan at the time of closing, you can keep putting down as little as 3.5%. Like if I bought a house 5 years ago, my wife and I are ready to sell today, I had put 3.5% down 5 years ago. I could do that again because I'm going to vacate this house to go buy my next one. And it's not like I'm going to own two houses at the same time. I'm going to sell one and buy the other potentially the same day. Right. I could put as little as 3.5% down.
So since we're on a conventional, how much, when it's an investment property, they already have a property, now they're going to buy another property. What's their down payment usually for that?
When I begin talking to a customer, I always ask them if they're a veteran or not. And if they are a veteran, they can get potentially, if their certificate, it's a single page, a certificate of entitlement from the VA, shows them that they could actually put down 0%. And it differs per county, like what the limit is, typically, but they can technically get a home with 0% down. It's a really good option, obviously, because these folks have served our country. They get the benefit of putting 0% down. They pay closing costs like anyone else would, and they can get a little gift from the seller up to 4% of the sales price if needed. So, you could have a veteran, pay literally nothing to buy a house. If the seller is willing to give them a gift and take the VA loan, yeah, you could have them pay nothing. Yeah, it's a pretty cut and dry loan. It's very flexible with some of its credit requirements. There is a floor. It's not sort of a hard and fast floor. Some folks might qualify for a credit score that's 600, some might not. Some might need a 620, some might not. It really depends. So you have to run that through VA underwriting. But all that being said, it's a 0% down loan for a veteran. It's a great option. The next loan type is a USDA loan. And that is income restricted, meaning you cannot make more than a certain amount and qualify. It's also geographically restricted. So you can't buy in downtown Tampa, for example. That's not a United States Department of Agriculture zone for the USDA guarantee loan. There is a map, it's a public map. So the areas in orange are not USDA eligible areas. So you can see if you point to Tampa, it's not an eligible area. And Clearwater and St. Pete, those, you're not going to be buying a property with no money down. But let's say you zoom in and you're over in Land O'Lakes, for example. You zoom up just a little bit. Yeah, there you go. And you want to buy up in San Antonio, up there to the right. It's actually a USDA zone. So in theory, you could buy a house with no money down out there. So that's it's good for our rural folks that want to buy a house in more of a rural area. And there's actually a little pin up at the top of the screen where this is a public site. You can just go to usda.gov and you can find it there. But if you take that pin and you drop it anywhere, it'll tell you whether it's a USDA approved area or not. It's pretty easy to determine that. So you can plug in
here in Land O'Lakes that it's on 41, there's a lot of new construction here. So all of those houses basically qualify for the USDA as well, correct?
Yeah, as long as you put it, what I would do is put in the address there where it says the Talco Ave, Spring Hill, Florida. Like I would put that at a specific address in and then click go and get right down to the street address. Because you really do want to get specific if you can. You don't just want to say like all of San Antonio is covered, because who knows, there might be a street an area that's not, but because we're looking at sort of a bird's eye view or beyond a bird's eye view. But yeah, you see it gets a little bit more specific.
Like right in here, there's a lot of new construction is what
yeah,
here
absolutely.
And all of this here growing too.
So the USDA loan is great for no money down, but it also does, not only are you income restricted, meaning you cannot make more than a certain amount. And right now that amount in Hillsborough County is $103,500. Like as long as you're making under that per year, you technically might qualify for a USDA loan if the property also sits in a USDA zone.
What was that? What was the amount?
103,500.
Oh, okay.
Okay. And that's as a family, they consider family income too. So even if one person's on the loan, they consider how many people are in the household that are working. And so they take that into consideration. Also, USDA does limit the amount that you can spend on housing. So where some of the other programs look at your overall financial picture and say, hey, you can spend up to half of your paycheck per month on total debts, including the housing. USDA says you are eligible to spend up to 43% of your paycheck. So it allows less debt to income ratio, which actually can kill the funding for the particular home that you're looking at. So you do have to look at your options, and that's where a mortgage lender is going to come in and really, like a doctor. I mean, the more information you share with us, the better the outcome is going to be, and the better the diagnosis. If you just say, I want a house and I have some money in the bank, that doesn't tell me a lot. So we really need to fine tune the program to you and make sure that you really qualify, and then it's going to be beneficial for you for the long term.
So we did FHA, conventional, V8, and USDA. And what was it?
There are no income loans as well, but not every lender offers those. I do happen to right now. We happen to offer them. Some of those programs come and go, but you can buy a home where you don't have to prove income. Typically, you're coming up with, at the very least, 20% down plus closing costs plus a broker fee. I mean, it gets a little expensive out of pocket, and every program is different. Like what I just told you right now in May of 2023 might not apply even next week. It really is as the lender behind it allows. But we do have those. I've closed a couple no-income loans this year.
The majority of these loans are mostly 20% down is what you were saying?
At the very least, yeah. So if you're a business owner and you make $300,000 a year, but you write off $298,000 worth of expenses, it's nice that you took in $300,000 in gross receipts, but in income, you took in $2,000. You can't buy a home with $2,000 worth of income per year. So what are you going to do? There's an option. It's called a no income loan. So you can look at a couple different ways. There's bank statement loans. There's no income asset verification loans. I mean, that's a whole other topic for another time. But really what I wanted to cover is the big four, the VA, USDA, FHA, conventional. Those are your big four.
On the conventional, did we mention I don't know. Did we get to mention about what was the question I did before? I forgot.
I
The
don't know.
3%, the 5%, the 10%. Did I say
We
that?
started. So like 3% is the minimum if you're a first time buyer. But let's say I sold my house today and I had a conventional loan, right? Whether I had a conventional or not, if I sold it today and I go to buy a house next week, like I'm not a first time buyer anymore because I've owned a home within the past 3 years. So if I go into a conventional loan, at the very least, I'm putting down 5%. And even as a first time buyer, people come to me all the time and they say, I'm a first time buyer. Great. But some of those benefits aren't the most advantageous. Like putting 3% down, you have not a lot of financial skin in the game. And so your interest rate's going to be higher. Your mortgage insurance will be higher. Even comparing off with, if I'm a listing agent on a house, and there are 3 offers and they're all for $300,000. And one of them's putting 20% down in a conventional loan. The other person's putting 3% down in a conventional loan. And let's say the third person's putting 3.5% down in FHA. I'm probably going to take the 20% down conventional. You know why that is?
That one is more likely to get approved than the other one.
Because they have some cash to put down, some money to put down. That's right.
Yeah.
So leading off with I'm a first time buyer, it's great that there are those benefits, but it doesn't always mean that you will get the house. It's actually, I would say, almost a detriment in a very competitive scenario. But I mean, sometimes it's the only way that folks can get approved is by putting the very minimum down. And that's okay too. But we just need to be conscious of the scenario for a particular house that the customer's making offers on.
Or their realtor just are really good in putting offers and knowing how to negotiate that.
That's it.
That offer and get it no matter what.
So you have a good realtor or you have a good lender who calls the listing agents and says, hey,
That's it.
Luciana is a solid deal. You should take it. And that's what I do. So, but yeah, there's a lot of components to it. It's why people feel overwhelmed, but it's not overwhelming. Once the lender helps select the loan program, from there, it's like a funnel. It's like you funnel down, you whittle your way down with interest rate that maybe the customer can afford and the housing, a monthly payment they can afford. And then from there, it's like a math equation that's already been solved. You just have to go find the house.
And sometimes it's really important too when, for example, like when we as a realtor have our preferred lender, it's because we're used to doing things and knowing what clicks and how it really worked that deal versus just getting any lender that they will do whatever and there's no communication. When we work together, we always try to not only me trying to do what's best, but the lender side as well. And together we can come up with a solution versus just doing separate. We try to always be a team and work and make it the best for our buyers. So that's one of the goals that we do and the things that we do together and why we click so well is because of that. We communicate, we try to solve that problem and not make it, oh, you're not going to be able to do it. No, we're going to try to do as much as we can, the best solution for you guys, just so you know that.
Right, exactly. Dream team right here.
That's it. So anything else would you like to add to this?
No, I think we covered it. I mean, there's the one thing in the world of mortgages that every loan officer knows this joke, but the one constant is change. It's always changing. Like FHA just lowered their mortgage insurance monthly premium. So that actually helps people to buy more housing, to have their housing, more of their monthly payment can go toward the mortgage principal and interest, which allows you to buy more of a house, a higher priced house, which is great. That really helps
that's
people.
Good. Again, tell me your name, who you work for, how they can connect with you.
Do you know who I am? No, I'm just kidding.
Kind of.
So that's good. So I'm Eric Bowers. I'm a sales manager with Crown Home Mortgage here in Tampa. That's Crown Home Mortgage. My phone number, if you want to text, call, I'm at 813-733-1001. And that's probably the easiest way to get a hold of me, or visit eBowers, that's EBOWERS.crownhm.com. And you can visit my site there.
Well, I will also have his information down in the description, so that way you can go directly to that. If you didn't catch everything that he said, click that, communicate, ask all the questions, he'll answer. Believe me, he'll answer because he answered all my questions. I am a pain in the butt when it comes to that.
No,
But he's really patient and he'll do whatever it takes to get you that loan. And if he tells you that it's not possible, let's work together. Let's see what we can do for you to get prepared to buy you that dream home. Again, if you like this content, let us know. Put comment below. If you have any question, just ask away. We'll be able to answer whatever it is, whether it's mortgage or anything real estate related. And until next time.
So that's it for this video. Let me know in the comments if you have any questions. And like always, if you like to buy or sell in the Tampa and the surrounding areas, I can help you with English, Portuguese, and Spanish. Just reach out. Till my next video. Bye-bye.